Hello and welcome back to the next part. So we're going to continue going over options. So I know it could be a little bit confusing. So again, you could change the strike. So this is just how many strikes you want to see. And again, strikes, what that means is the price of the actual stock. So $118 a share, $119, $120. So you might be thinking, how can I purchase Apple at $118 when it's currently trading at $121? So again, the option, it gives you the right to buy the stock at that certain price. But what you do have to know is if you do want to get the shares of the stock, you have to have the money available. So I'm looking at this right here, this top one, 118 strike. So the $118 for Apple. So you would put that non-refundable deposit for $400 down, right? So you would pay, again, one contract is equal to 100 shares, so that's why it's multiplied by 100. So you would pay $410 as your non-refundable deposit. Again, you could sell it anytime. So say your deposit and the demand goes up to $500, you could sell it and make $90 to $100 profit, right? Because I'm going to get into that and how you're going to determine what that means. And so you're putting that deposit down of $400, and say by March 19th, it's over $118. So you could buy, if you wanted to, at $118. So what you would do is this $400 that you put down as your deposit is just to hold the stock at that price. So you still have to come up with $11,800 because again, you take the 118 and you multiply it by 100, right? To get the amount of shares, because you're going to get 100 shares for one contract. So you need $11,800 to own Apple at $118. So if you wanted to do that, you could definitely switch it long as you have 11,800 available. And if Apple is trading at 121, you could turn around and sell it to someone for 121 and make a $3 or $300 profit on that. So that's kind of what that means with the strikes and thinking about this. So again, if something happens, if news comes out and Apple actually goes under $118 by March 19th, your deposit is actually going to turn into zero, right? Because the whole point of an option is you want to find someone, buyer and seller, and that's what your broker does. The broker will find a buyer and seller and match them up together. And so if you're trying to sell Apple at $118, but say Apple's at $115 by say March 19th, then no one's going to be willing to pay for your price at $118. So that's why you would lose all your money and it would be $0 because someone's going to look at buying Apple at $115 because it's cheaper than your current price. So hopefully that makes a little sense. Again, just let me know if you have any questions or if it's still a little bit confusing. And then now the next upcoming videos, we're going to determine some good pricing and how to determine the change and how much you would actually make on each option. So we'll see you on the next video.